You know, I'm not going to make a habit of paraphrasing Jamie Dimon, but it sounded like he said that stocks and bonds are priced to perfection.
Yeah.
Did you agree?
Yeah,
Okay.
they're priced for that soft landing.
So if you agree with him, it sounds like you do. What does that mean going forward? I mean, it sounds like if anything happens, we could see a sell-off, we could see a dip. Do you agree with that idea that we need almost everything to go right going forward to keep this rally going?
Yeah, well, I think that that's the case because as soon as the Fed starts communicating that it might start to cut rates, the market prices in the entire path, the rate cutting path. So in one sense, the Fed just needs to deliver that. What if the Fed does not deliver that?
When you say not deliver, does that mean 25 basis points if they only do 25?
No, but we're talking about the entire path, right? So look, the fixed income market is placing a 40% probability that the next cut could be 50 basis points. And I don't think the Fed is particularly going to die in battle over whether it's 25 or 50 if the data point to more weakening.
Okay.
But in terms of the entire path to where the Fed could get in this cutting cycle, the market has already priced that in. So let's say the economy does better than expected and the Fed cuts but doesn't cut as far as markets are already pricing. You're going to have yields come up to reflect that. And how does the stock market then react? It is a better economy.
Right.
But you're not getting as much cutting as you had already assumed in your forward.
That's interesting. So we're going to turn back to the equity market in just a second. But I do want to talk about bonds. You're mentioning a scenario where these bond yields go up. So then how does that shape your view of the bond market? Well,
so if the bond market right now is pricing in that we get to just above 3% by the end of next year. So it's all about a timing thing. If the Fed starts with a string of 50 basis point cuts, it's likely that they get enough lift to an economy that you could actually see a reacceleration in the economy as we're moving into the first half of next year. And so the Fed has cut a lot more up front, but may not end up cutting as much overall. So you front-loaded a lift to the economy.
So does that mean that you like short end of bonds or long end of bonds?
So you want to own more steepening of the yield curve there, but on a shorter time frame.
Okay. Let's turn back to equities for a minute. How are you seeing the overall market? We were talking earlier to another guest, tech showing some more leadership again, but at the same time we're seeing broadening. We're seeing rally in energy stocks, we're seeing a rally in payment stocks and financials. Where are you seeing the biggest opportunities going forward with the idea that we're going to get more cuts?
So if we're going to get more cuts, right, again, it's about a timing thing. What typically happens when the Fed is cutting, you eventually are going to have a lift to cyclicals. Now, we've had some cyclical response. So we've seen spending on durable goods items pick up because interest rates have been coming down. Those are very interest rate sensitive. We are having some response in housing activity, although it's muted because of that lock-in effect. But cyclicals usually have a tough time when the Fed's cutting, and then they start to pick up.
So your pick for us are alternative asset managers like KKR, Apollo. We're almost out of time, but very quickly, elevator pitch. Why is that attractive right now?
Why is that attractive? Because we're in an uncertain cycle where the Fed is cutting, but they're cutting while the economy is okay. And in that environment, where we don't have to prepare for disaster like we normally do when the Fed is cutting.